Hello and welcome to yet another episode of Legal Wrangle on International Taxation. In this episode, we present before you cases relating to withholding tax liability in case of interest payment to AE, TP adjustment on account of interest paid by availing extended credit period, treatment of foreign distributor from whom assessee made most purchases as its AE, withholding tax liability in case of reversal of ledger entries and charging of hypothetical rate of interest in case of default in repayment of the loan by AE. Our first case deals with the issue as to whether interest income can be considered as deemed to accrue or arise in India when the same is payable by an Indian assessee to a non-resident in respect of any sum borrowed and used for the purpose of a business or investment outside India. The assessee is Adani Enterprise Ltd, engaged in power generation, transmission and distribution of coal energy. Now let's go to Maneet for the details of the case.
The assessee had made remittances on account of interest on foreign currency convertible bonds payable to its non-resident bondholders without deducting TDS under Section 195. The AO took the view that such interest accrued or arose in the hands of non-resident bondholders in India as soon as it became due to them, and since the bonds were direct and unsecured obligation of the assessee, tax was required to be deducted at source. He treated the assessee as assessee in default.
The tribunal observed that Section 9(1) excludes interest paid to non-resident investors by an Indian resident if such interest payment is in respect of any sum borrowed used for investment outside India. Such exclusion in Section 9(1) proves that it falls within the ambit of deeming provision, and since it is falling within the ambit of this exclusion, clause of income deemed to accrue or arise in India, no tax is required to be deducted at source. In our second case, the key issue was whether any TP adjustment was required in cases where the assessee had paid more than the price mentioned in the CEPC journal for importing cashew from its AE, when it had availed 150 days credit period for such transaction and when the normal credit term was 30 days. The assessee is Reliable Cashew Company Private Limited, engaged in export supply of cashew nuts. Here are the case details.
The assessee had imported raw cashew at an average credit term of 150 days from its AE and accordingly computed interest on all import transactions at bank rate of 12% on the credit term in excess of 30 days. The TPO observed that availing credit period for payment is a standard industrial practice and no concession is given to assessee for the extended credit period. He accordingly reduced the interest claimed by assessee from the purchase price.
The ITAT observed that due weightage is to be given towards interest benefit enjoyed by the assessee since it availed extra credit period. This is also permitted under Rule 10B. If due credit is to be given to interest at the rate 12% for the credit period, there is no necessity for any TP adjustment. In our third case, the key issue is whether a foreign distributor to an assessee can be declared as its AE requiring TP adjustment merely because the assessee has purchased 95% of its equipments from such distributor when assessee's prices are not influenced by such transaction. The assessee is WB Engineers International Private Ltd, engaged in trading of earth-moving equipments, mining equipments and fuel energizers. Let's go to Maneet for the details of the case.
During assessment, it was noticed that the assessee had imported trading goods only from a single source and was also getting commission of 5% of net sales value for the orders which were directly executed by the foreign distributor. Accordingly, it was held that assessee was the AE of such foreign distributor, that is the Terex Corporation.
The ITAT observed that the DRP's findings that prices and other conditions relating thereto was not influenced either by the assessee or Terex Limited was not controverted by the revenue. A bare perusal of various clauses of the distributor agreement shows that both the assessee and the foreign distributor were independent parties. Therefore, merely because a company had made 95% purchase of its equipments from a single distributor, such distributor cannot be treated as its AE and no TP adjustment is applicable on the same. In our next case, the key issue is whether credit of the amount to the account of a non-resident maintained in the books of the pair would be subject to withholding tax only if the credit of such amount reflects accrued income in the hands of the payee which is chargeable to the tax under the Act. The assessee is Ericsson Communications Ltd, engaged in the business of installation and commissioning of telecom projects. The assessee had entered into an agreement for use of its AE's trademark Ericsson and in turn was obliged to pay royalty. Let's hear the facts.
Consequent to the said agreement, the assessee credited the payment of royalty to its AE's account. However, no tax was deducted in respect of the said payment. Subsequently, the assessee reversed the entries by debiting the account of its AE and crediting royalty account, thus nullifying the entries passed earlier. The AO thereafter passed an assessment holding that the assessee had defaulted in deducting tax at source and was therefore directed to pay interest under section 201(1) read with section 201(1)(a).
The High Court held that the credit of an amount to the account of non-resident maintained in the books of the pair would be subject to withholding tax only if credit of such amounts reflects accrued income in the hands of the payee which is chargeable to tax under the Act. Thus, an assessee cannot be held to have acknowledged the payment of the royalty by crediting the account of its parent foreign collaborator where it has reversed such entry in its books by acting upon the clarification letter issued by Government of India FIPB. The High Court further held that mere passing of such book entries which are reversed would not give rise to obligation to withhold tax, as ultimately there is no debt that can be said to have been acknowledged by the assessee. In our last case, the key issue is whether a hypothetical rate of interest which could have been charged by an assessee from its AE in case of default in repayment of loan can be taken for the purpose of determining ALP of the said international transaction by using CUP method. The assessee is Bumi Highway India Ltd, engaged in business of road construction. The assessee had advanced loan to its AE and had charged interest at the rate 9% on the outstanding amount which was not recovered from the AE. This was the rate at which its bank had charged the assessee on borrowed funds. Let's go to money for the details of the case.
The assessee in its TP study claimed the charging of interest from its AE to be at arm's length. This submission was however rejected on the ground that the AE had persistently defaulted in payment of the principal as well as interest, and in that situation the AE should have paid interest at 18.5% per annum.
The High Court concluded that the possibility of the AE in its discretion rolling over the loan and not charging a higher rate of interest in a given set of circumstances where the repayment of the loan was not timely couldn't be ruled out. In applying CUP, one has to go by what was actually charged in comparable transaction and not a hypothetical transaction. Therefore, there was no question of substituting 9% that was actually paid by the AE with the hypothetical rate that might have been paid in an eventuality that never occurred. Well, this brings us to the end of this episode of Legal Wrangle on International Tax. You may write to us your comments, criticism and counsel at editor@TIOL.in. Please do subscribe to our TIOL Tube channel on YouTube. It's free and will keep you updated on the new posts. Have a good day.